Okay, hi. Last time I gave you 11 tips how to be a great value investor, and today I would like to add up to those. I took a ferry from Brooklyn to Manhattan, so my 12th tip is a crisis is great, don't be worried, just keep on holding your stocks. I would never sell in a crisis. The stock market long term goes always up. That was my 12th tip. My 13th idea is just avoid the mistakes the masses are doing. What do they do wrong? They trade too much, they don't look at the trading costs, and they get too emotional, so don't do that. A 14th tip is what I said with the being too emotional is think about what happened during the stock market bubble in the year 2000. People got and bought like AOL.com and got too crazy about it. They got like fans and were too excited, so the price PE ratio was nuts, and just don't get too emotional. That is my 14th tip. 15th tip is um, that don't look at the economy itself, look at the companies. Don't come from a broader perspective, because companies grow out of those recessions, they get over it. And if you just focus too much on the economy overall, it's too complicated to find the right stock. 16th tip is keep a little bit cash so you can keep on buying if the stock further goes down. If your favorite stock further goes down, you add to your position. 17th idea I have is don't buy weak balance sheets, buy great companies with great balance sheets. You just want rock solid stocks, you don't need risky stocks. 18th tip is look at the long-term stock and the chart. If like for 30 years the stock went nicely up decade after decade, that's a great stock. It tells you a lot. A chart over 30-40 years. Warren Buffett usually buys great companies that are going up over the decades. 19th step is don't sell your great stocks, keep them for the long run. Most people are doing that mistake. They just sell it, make money, and but they have not the time. You need a lot of time to build up your interest rate and the compounded interest effect. 20th step is just don't take loans, don't take credit, just buy stocks with equity, with cash you have. It would be silly to take a loan to buy a stock. It's just too risky, it costs interest that's not needed. 21st step is small companies are great. I would focus on large caps, add a few small caps, that's fine. 22nd step is just think about what it is. Value investing, it is you buy stocks with a nice dividend and that perform nicely over the years. If your stock goes up 10, 12, 11% a year, that's great. You don't need 100%. That's too risky, that's too expensive. 23rd step is don't keep too much cash. Huge amounts of cash make no sense. 24th step is avoid investment funds. They are expensive. 70 to 80% of the professionals don't perform better than the overall market. Think about that. 25th step is dividends are great. Buy stocks just with nice dividends, 2, 3, 4, 5% dividend yield is fantastic, and that gives you cash, that's a very important tool, the dividends. 26th step is you need time. The more time you have, the better it is. And if you have time for decades, that's fantastic. You will have a great performance on the long run with great stocks. So these are my 26 tips to be a successful investor.